Hello again, accounting friends and family. Welcome back to Accounting 1101. With you as always, I'm Professor Martin, leading you on your accounting journey, which today is taking you to transactions. And we're trying to figure out how to plug transactions into the accounting equation. Now, if you think back to our last video, you remember the accounting equation and the different parts of it. Hopefully, you can look at that little equation right there and fill in the blanks for me. If you want to take a moment and pause and try to do that, that would be great, because we need to know that assets equal liabilities plus equity. We said that right there is a foundation for all the accounting that we're going to do. We also give a few definitions on the different parts of the accounting equation. We said assets were stuff a business owns. You know, a really technical definition, stuff. But that's what it is. Assets are stuff a business owns. And we talked about how liabilities and equity were basically amounts that were claims to that stuff held by creditors or the owners of the company or the business. All right. So our accounting equation, stuff is equal to claims to stuff. Assets are equal to liabilities plus equity. And we need to know that inside and out. Today, we're going to show you how to plug transactions right into that accounting equation and how transactions are going to impact the accounting equation. But before we get into that, let's talk a little bit about what a transaction is. A transaction is any business activity or event that affects our financial information. And so to give you some examples, investing into the business would be a transaction. Buying land or buildings for the business, buying supplies, selling a product or service, paying expenses, paying back money that is owed. All of those are examples of transactions. Now, those aren't the only transactions we can be involved in, just a few examples. All right, and we're going to try to show you as we move along how these examples would plug into our accounting equation. The other thing we need to say as we're talking about transactions, every transaction has an impact on the accounting equation. All right, every transaction is going to impact our accounting equation. Now you can hopefully see why it's so important that we know the accounting equation, seeing that every transaction that we're going to do is going to have some kind of impact on the accounting equation. And again, to tie it back in with our very first video where we talked about how we're not just doing things to train accountants, we're also helping people understand business. That's the exact same idea right here. Even if you're not going to end up in a career where you're actually recording the transactions, you still need to understand how they impact the accounting equation, how they impact the finances of your business. Very important. We're going to have an example business or a sample business that we're going to be working transactions for. Net Solutions is the name of the business. It is a business where the owner is doing web page design, consulting, different stuff like that. Service business, not selling a product, but providing a service to a client. The founder is a person named Chris Clark. And we're going to assume that the company begins on November 1, 20Y3. We put the Y in there just so it's kind of a generic fill-in, and that we don't have to use a specific number. 20Y3. If you want to assume 2023, you're more than welcome to. So we're going to see how some basic transactions impact the accounting equation for Net Solutions. So here we go. Right here at the top, we have our accounting equation. Assets equal liabilities plus equity. Hopefully you're starting to become familiar with that. If nothing else, hopefully me saying it over and over again is burning it into your brain. But we have our accounting equation. You notice I've listed a few different accounts here to help us keep track of what's going on. I've got a cash account under asset, cash being something that we own in the business. And over here, I've got something called Chris Clark Capital under equity. We know equity is the area that we're going to record ownership, the owner's claims. And so I have right here, Chris Clark Capital, which represents the amount that Chris Clark has invested into his business, Net Solutions. Transaction number one. Are you excited? Our first transaction. Man, we are getting accounting done here. November 1, 2023, Clark deposits $25,000 in a bank account in the name of Net Solutions. Remember our business entity assumption that the business is a separate thing from the owners? Here we go. This is that played out in real life right here. Clark is putting his own money into the business, a separate thing. His personal monies, business monies are separate. Business is its own thing. So $25,000 going into the bank account for Net Solutions. So we're trying to record the fact that now we have money in a cash account, and now Chris Clark has invested into the business. So how would we record that into the accounting equation? Well, the asset side underneath cash is going to go up $25,000. The equity side under capital is going to go up $25,000. Remember one of our key rules here, the accounting equation always has to be in balance. I put $25,000 in on one side. I put $25,000 in on the other. Accounting harmony. We are in balance. We're always seeking to find accounting harmony. All right? And we found it here. $25,000 under the asset side, represented under our cash account. $25,000 under the equity side, represented under the capital account. How about another transaction? On November 5th, Net Solutions paid $20,000 for the purchase of land as a future building site. So the business bought some land. You'll notice I've added a land account here. We still have our cash account with a balance of $25,000. We still have the capital account under equity with a balance of $25,000. How would we record the purchase of land? Well, think about what's going on here. We're paying cash. Cash has to go down. We're getting land. Land has to go up. Cash goes down $20,000. Land goes up $20,000. Even though that transaction is happening solely on the asset side of our accounting equation, it's still cool because it washes itself out. One asset goes down, one asset goes up. And then we can look at the new balances. We now have $5,000 in cash. We have $20,000 in land. On the asset side, total, we have $25,000. Equal $25,000 on the liabilities plus equity side. So again, after every transaction, our accounting system has to be in balance. How about transaction C here? November 10th, 20Y3, Net Solutions bought supplies for $1,350 and agreed to pay the vendor later on down the road. So you'll notice I've added a new account under assets called supplies. And I've also added a new account under liabilities called accounts payable. Because I'm paying later on, that's a liability. And when we buy something from a vendor, whether it be supplies or inventory, and we agree to pay them later on, that's called an accounts payable. Anytime in accounting you see that word payable, you need to be thinking, we have to pay somebody. That's why they call it a payable. I got to pay somebody. So later on, you'll see accounts payable, you'll see wages payable, interest payable, taxes payable. Anytime you see the word payable, you're thinking, I have to pay somebody. I owe somebody. I have a liability. All right, so let's go ahead and plug that into our accounting equation. $1,350. Our supplies are going to go up. That liability is going to go up. Accounts payable. Business buys something on account. We're buying now, we're paying later. Supplies, you can see, goes up $1,350. Our liabilities go up $1,350. I put $1,350 on one side, I put $1,350 on the other. And my new balances, I now have $1,350 in supplies. The cash still there, the land still there. On the other side of the equation, liabilities and equity, $1,350 and $25,000. I've got $26,350 on the asset side if I add everything up. And if the accounting gods are smiling on me, on the other side of the accounting equation, liabilities and equity will also equal $26,350. assets equal liabilities plus equity. Not to beat a dead accounting horse, but every transaction, the accounting equation is in balance. All right. Moving along, another transaction here, D. November 18th, Net Solutions completes a job for a customer, and they are paid $7,500 in cash. So Net Solutions designs a website for a customer. The customer pays them $7,500 and says, "Great job." You'll notice I've added a new account under equity called Fees Earned. Fees Earned is a revenue account, no different than maybe you might see it called sales revenue, service revenue, whatever the case might be. We use some different things to describe revenue, but right now we're just going to call it Fees Earned. We've earned some money, and we've done that from creating a website. So $7,500 in cash was paid. Our cash account needs to go up $7,500, and we need to reflect the fact that we've earned $7,500 in revenue. Fees earned, sales or revenue earned from providing services. So here we go. $7,500, cash goes up, fees earned goes up $7,500. And we got new balances. Our cash account is now $12,500. The other account balances are going to stay the same except for fees earned, which we just added $7,500 into. Now, if you're thinking ahead, you might say, well, Professor Martin, we need to make sure that we still balance. And I like the way you think. Let's go ahead and do that. $33,850 on the asset side. $33,850 on the liabilities plus equity side. We're good. Accounting harmony has been maintained. How about transaction E? End of the month in November 30th, Net Solution pays expenses in cash. We paid wages to our employees. We paid for rent. We paid our utility bills, and we paid miscellaneous expenses of $275. You can see the amounts right there. Wages $2,125, rent $800, utilities $450, and then miscellaneous expenses. When we have revenue, as we saw in the previous transaction, that makes equity go up. When we have expenses, like rent expense or wages expense, it makes equity go down. So we subtract it out on that equity side. All right. Now, I'm not going to list all the expenses separately right here. I'm just going to lump them all under expenses. If we add all the numbers up, we get $3,650. We paid that in cash. So cash is going to go down $3,650, and expenses over here, $3,650, are going to subtract from equity. I'm subtracting from the asset side. I'm subtracting from the liabilities and equity side. All right. Again, we're still in balance. Our new balances are right there. After we take out the $3,650 in cash, we're at $8,850. And you can see we put the expenses over here as a subtraction from equity. $30,200 on the asset side is equal to $30,200 on the liabilities plus equity side. And if you don't trust me that I did the math there, get out your calculator. As an accountant, you can never be too far from your beloved trusty calculator. Math it up and see if you get the same thing. Double check me. If you find an error, let me know, and I'll throw some bonus points your way. All right, and then I'll edit that error out of the video. But right now, I think we're okay. Assets equal liabilities plus equity. Next up, on November 30th, we paid back $950 of the amount we owed to our supply vendor. Remember earlier, we bought supplies on account. We bought the supplies, buy now, pay later, and we recorded that accounts payable. We owe $1,350 to our supply vendor. We're going to pay him back a little bit. Not paying back the whole thing. We're paying back $950. Cash is going to come down. That accounts payable is going to come down. When we pay an amount we owe, it reduces a liability. All right, and we're going to see that right here. We're reducing the liability. We're paying back some of the money we owe. When we pay an expense, as we saw in the previous transaction, it reduces equity. And we see right there, we got expenses reducing equity. Paying back the amount we owe, $950. Cash is going to come down. Accounts payable is going to come down. cash is coming down. We wrote a check to pay for the amount we owed, and we don't owe that amount anymore because we paid it back. Our new balances, $7,900 in cash, $400 in accounts payable. All the other balances stay the same. And again, we're going to check to make sure we're still in balance. $29,250 on the asset side equals $29,250 on the liabilities plus equity side. Still looking good. Moving along, November 30th, we're doing a lot of accounting here at the end of the month, right? Net Solutions counted their remaining supplies and determined they had $550 left over in supplies at the end of November. Now, we bought $1,350 in supplies. We stuck them in a supply closet. Maybe we bought pens and paper and printer ink and Post-it notes and whatever you can think of office supplies. All right. We bought $1,350 worth of them. We stuck them in a supply closet. We've been using them throughout the month. I'm not going to make an accounting entry every time I get out a pack of Post-it notes, right? I mean, we'll make an accounting entry for 75 cents or whatever, a pack of Post-it notes might represent. No, that would be completely time-consuming and inefficient. So what I'm going to do instead is I'm going to count one time at the end of the month, see what I've used up. So somebody did that. We sent an intern or somebody who is not very high up on the totem pole to count supplies. And they came back and said, hey, we have $550 worth of supplies left. Well, that's a problem because we have $1,350 in our accounting records. So we need to reflect the fact that we've used up supplies. If we had $1,350 originally, we now have $550. That means we've used up $800 worth of our supplies during the month. So let's throw that into the accounting equation. We've used up $800 of supplies, and therefore we have $800 in supplies expense, right? We still have some supplies left on hand, but we've used up some. So that $800 represents what we've used up. Our supply balance goes down, and we reflect the fact that we've used $800 of supplies or incurred an $800 supply expense during the month. Our new balances, you can see supplies now shows $550, which is the amount left over at the end of the month, which is what we want. Our new expense balance is $4,450. Our accounting equation, $28,450 on the asset side, $28,450 on the liabilities and equity side. Let's do one more transaction. At the end of the month, the owner, Chris Clark, decides to take $2,000 out of the business. Again, the business entity assumption, two different things. So the owner's going to take money out of the business, put it in his own personal checking account. And so we need to reflect that money coming out of the business. We'll let Chris Clark worry about his own personal checking account. We're just worried about the business side of things as accountants. So $2,000 out of Net Solutions for personal use. You can see I've added a new account called Drawing, Withdrawal. The owner is withdrawing money. So we're taking away from equity. If we add to equity when the owner puts in money and tracking it with a capital account, when the owner takes out money, it's subtracting equity, right? So $2,000. Owner draws are not business expenses. All right, I'm not going to account for it in the expense category here. I'm going to account for it as a draw. Owner puts money in, it adds to capital, they take money out, it's a draw. $2,000 out the door from the cash account, and we see a negative $2,000 coming on the equity side, subtracting $2,000 in equity. Our final balances, $5,900 in cash, $20,000 in land, $550 in supplies, $400 in accounts payable, $25,000 in capital, a $2,000 subtraction from equity through drawing, $7,500 added to equity from revenue or fees earned, and then $4,450 subtracted from equity through the various expenses that we incurred. Add it all up on the asset side, $26,450. On the liabilities plus equity side, $26,450. Put it all together in one place. You can see all the transactions, A through 8 right there. They've expanded the expenses. I kind of lumped all the expenses up into one number, but you can see the expenses broken out here: wages, rent, supplies, utilities, miscellaneous. You can also see the drawing account right there under equity, all in one place. So our takeaways here as we plug transactions into our accounting equation. First of all, every transaction that we have is going to impact the accounting equation in some way, shape, or form. The two sides of our equation are going to be equal after every transaction. If they're not, we've boogered something up and we've got to fix it. All right? The accounting system always has to be in balance, always has to assets equal liabilities plus equity. Equity is going to be increased on the equity side by owner investments, as you can see in our capital account, and revenues, as you can see in fees earned. Equity is decreased by owner draws, as you can see right there, and expenses. So that's it. Plugging transactions into the accounting equation. Hopefully you can kind of see how transactions impact the accounting equation. Moving forward, we're going to talk about how we plug transactions into the individual account. You could imagine if we're plugging every transaction into the accounting equation for someone like Walmart, who literally has millions of transactions every day, that would become a little bit unwieldy. And so moving forward in our next chapter, we're going to talk about how to record transactions into individual accounts, as opposed to just plugging them into the accounting equation. So that's where we're going. We're going to keep on keeping on until we have all become very well versed in the mechanics of accounting and bookkeeping. If you have any questions on what we just looked at, I'd be happy to help. If you're working on your homework and trying to apply that and you find yourself stuck or having troubles, hey, reach out. Let's talk about it. Contact information right there. I'd be happy to help. Until next time, take care, everybody.